name's Brooke Matherne, and I'm going to explain the 3 financial analysis, the companies. I did Walmart, which is the largest discount retailer in the world. They provide grocery store and pretty much everything else that you need. Did Amazon. It's the largest online shopping website. They're known for their books, their electronics, music, furniture, and other apparel. And also Sanderson Farms, which is the 4th largest chicken producer in the United States. Looking at these companies, I'm going to answer questions like, should you make a short-term loan? Should you make a long-term loan? Or should you purchase equity or not? The first company is Amazon. We're going to look at the quick ratio, the current ratio, and the cash ratio first. The quick ratio is whether or not the company is able to make the short-term loans or not. There's numbers in 2012 was 0.78, 0.75, and 0.82. And their current ratio is whether or not a firm has enough resources to pay its debt over the next 12 months. Their numbers were 1.12, 1.07, and 1.12. The cash ratio is the company's ability to cover its liabilities, which is 0.60, 0.54, and 0.62. The cash and current ratio, they were the 2nd largest compared to Walmart and the Sanderson Farms. We would not make a short-term loan to Amazon. And then also their financial leverage is how is the company being financed, like by debt or by equity. Their numbers were 3.63, 4.05, and 4.62. They had the highest financial numbers compared to the other 2, which means that they were mostly financed by by debt. So you would make a long-term loan to Amazon, but you would not purchase equity from them. Their price to earnings ratio is the current market price of a company's share dividend by the earnings per share of the company, which is their numbers were 130.54, 1,124.94, and 682.83. Their numbers are so high because the market has and still expects high future growth ratings from Amazon. The return on equity is the amount of net income purchased as a percentage of the shareholders, which is 2.17, 3.18, and it was negative 1.27. The next company is going to be Walmart. Their quick ratio was 0.20, 0.20, and 0.20, so they didn't decrease or increase. There was just no change. The current ratio was 0.88, 0.83, and 0.88. And the cash ratio was 0.11, 0.11, and 0.10. So they're pretty stable on their ratios. This was the lowest. They had the lowest ratios out of the other 2 companies, since it's so low that you would not make a short-term loan. The financial leverage was 2.68, 2.69, and 2.67. They had the 2nd largest numbers, so we would also not make a long-term loan to Walmart as well, but we would purchase equity from them. Their return on equity was 22.61, 23.06, and 21.67. The last one is Sanderson Farms. Their quick ratio was 0.93, 1.20, and 1.92. The current ratio was 2.93, 2.67, and 3.46. The cash ratio was 0.21, 0.53, and 1.12. The cash, current, and quick ratio was mostly higher in comparison than other 2 companies. Amazon had a slightly higher cash ratio in 2012 and 2013, which means that we should still make a short-term loan to Sanderson Farms. Their financial leverage is 1.75, 1.49, and 1.30. This means that this financial leverage was a lot lower than the other two. This means that the company was mostly being financed by equity and not by debt, because of that we would not make a long-term loan and we would not purchase equity from them. And those are my three companies.